Every year, billions of dollars flow across borders, from poor nations to rich ones. But if wealth is always moving, why does it almost always move in the same direction? Why do some countries rise effortlessly, while others remain trapped, decade after decade, in the same cycle of debt and dependency? To understand why poor countries stay poor, we have to step back from the headlines and look carefully at the hidden architecture of the global economy, the quiet rules, written long ago, that still decide who gets ahead and who falls behind. When people talk about development, they often mention hard work, innovation, education, or political stability. And yes, those matter. But there is something deeper underneath them all, something structural. It is the monetary and financial system itself. The way money moves between nations, the way credit is created, the way prices and currencies are set. These invisible forces shape the destiny of entire populations. They determine which nations can build and which remain dependent on others for survival. Let's begin with a simple truth. Modern economies are built on debt. Every factory, highway, hospital, or power plant starts with borrowing. But not all debt is created equal. $1 of debt in the United States or Germany is not the same as $1 of debt in Nigeria or Bangladesh. In wealthy nations, debt is a tool for expansion. In poorer nations, it often becomes a trap. Why? Because of the currency it's owed in, the interest attached to it, and the systems that control its flow. After World War II, the global economy was reorganized around a single idea: stability through the dollar. At a conference in 1944, world leaders created a system known as Bretton Woods. It made the US dollar the anchor of international trade. From then on, if a country wanted to buy oil, machines, or medicine, it first needed US dollars. This gave the United States enormous power. It could create the money that everyone else needed. For developing countries, this meant that growth required not just productivity, but access to dollars. To get them, they had to borrow, export raw materials, or attract foreign investment. Each of those paths came with strings attached. When poor countries borrow, they often do so in foreign currency, usually dollars. Imagine running a business where you earn money in your own currency, but owe your debts in another. If your currency falls in value, your debt suddenly explodes. That's exactly what happens to nations across Africa, Asia, and Latin America when global interest rates rise or the dollar strengthens. Their local money buys less, their debt payments balloon, and budgets meant for schools or hospitals are redirected toward paying foreign creditors. The International Monetary Fund and the World Bank were created to help manage this system, to lend money during crises and promote stability. But over time, their loans came with heavy conditions. Countries had to cut spending, privatize industries, remove subsidies, and open markets to foreign competition. These policies, known as structural adjustment, were meant to make economies more efficient. In practice, many of them dismantled local industries, increased unemployment, and made nations more dependent on imports. Factories closed. Farmers faced cheaper foreign goods flooding their markets. Governments lost control of key sectors. Growth slowed. Meanwhile, multinational corporations, backed by rich nation capital, moved into these same markets. They extracted minerals, oil, and labor at low cost and sold finished goods back at high prices. The value chain was uneven from the start. The poorest countries exported raw materials. The richest exported finished products. 1 ton of cocoa beans might earn a farmer a few $100s, but 1 ton of chocolate earns millions for a foreign company. Over decades, that imbalance compounds, keeping wealth concentrated in the same hands. But this story isn't just about economics, it's about power. The ability to set the rules of trade, finance, and production is the real foundation of wealth. The institutions that write those rules, the IMF, the World Bank, the World Trade Organization, are largely influenced by rich nations. Voting rights are proportional to the size of an economy. The largest voices decide the policies, while the smallest have to adapt or lose access to funding. It's a polite form of economic control, wrapped in the language of cooperation. Currency value plays another huge role. Most developing countries suffer from chronic inflation and unstable exchange rates. When a local currency loses value, imports become expensive, savings lose power, and businesses struggle to plan. Investors demand higher returns to take the risk, which raises borrowing costs even further. A nation trying to grow ends up spending more on interest payments than on education or innovation. The stronger the dollar becomes globally, the weaker these economies feel at home. Think of it this way: the modern world runs on confidence. The US dollar is trusted because people believe in the stability of the US government, its institutions, and its military strength. But a developing country's currency doesn't enjoy the same trust. Even if it's backed by resources, the market still prices in risk, history, and perception. That perception can take decades to change, if it ever does. So while the rich world borrows cheaply, the poor world pays dearly for the same privilege. To make matters worse, global trade rules reward those already industrialized. Tariffs on raw materials are low, but tariffs on finished goods are high. That discourages manufacturing in poor countries and locks them into their role as suppliers of cheap inputs. Add to this the fact that global brands dominate distribution and marketing, and local producers rarely climb beyond the first step of the value chain. The result? More work, less reward. We have to also talk about technology and knowledge. The most profitable industries today, software, pharmaceuticals, aerospace, depend not on raw resources, but on patents and intellectual property. These are protected by global treaties that give long monopolies to those who invent first, which are almost always corporations from developed nations. So even when poor countries build factories, they still pay licensing fees and royalties to foreign owners. In a sense, it's a new form of rent, the rent on ideas. Foreign aid, often presented as generosity, doesn't change this structure much. Every year, billions are given in loans, not gifts, and much of it circulates back to donor countries through contracts, consultants, and interest payments. For every dollar that flows into a developing country as aid, several dollars flow out as profit, debt repayment, or capital flight. This net outflow quietly drains the resources that could have built schools, roads, and industries.
Capital flight is another hidden wound. When local elites or corporations move their money offshore, they protect it from local instability, but they also deprive their own nations of investment. It's estimated that African countries collectively lose tens of billions of dollars each year to illicit financial flows. That's money that could have funded infrastructure or innovation, but instead it sits in foreign banks earning interest for someone else. Another factor is history, specifically the legacy of colonialism. For centuries, colonies were structured not to develop themselves, but to supply the metropole. Railways were built to move minerals to ports, not to connect cities. Education systems trained clerks and interpreters, not engineers or scientists. When independence came, many of those structures remained. Economies designed for extraction simply changed owners, not purposes. Colonial currencies were often replaced by local versions pegged to the former colonizers' money, keeping the same dependency in a new form. Even today, the echo of colonialism lingers in the form of resource contracts, language of trade, and legal systems. For instance, several West African nations still use the CFA franc, a currency tied to the euro and guaranteed by the French treasury. That guarantee brings stability, but it also limits flexibility. To change monetary policy, those countries must seek approval from foreign institutions. It's a quiet continuation of economic oversight disguised as cooperation. Global supply chains have deepened the divide. A smartphone assembled in Asia may contain minerals from Africa, software from the United States, and design from Europe. But where is most of the profit made? Not at the mine or the factory floor, but at the stage of branding, technology, and finance. The lower a country is positioned on that chain, the smaller its slice of the pie. To climb higher, nations need investment in education, research, and infrastructure, exactly the things hardest to afford under the current debt pressures. Let's pause for a moment and look at what poverty really means at the national level. It's not simply a lack of money, it's a lack of control over the sources of money. When a government can't influence its currency, interest rates, or trade terms, it's forced to react rather than plan. Economic sovereignty becomes limited, and policies become dependent on the expectations of foreign investors and lenders. That's why a sudden change in global markets can push an entire country into crisis overnight. Take the example of the 1980s debt crisis in Latin America. Many countries borrowed heavily during the 1970s when interest rates were low. But when the U.S. Federal Reserve sharply raised rates to combat inflation, the cost of servicing those debts skyrocketed. Economies crashed. Decades of progress were wiped out almost instantly. The pattern repeated in Asia in the late 1990s and again in parts of Africa after 2014 when commodity prices collapsed. Every cycle leaves behind the same question. Why is the system so fragile for the poorest? Because the rules are not neutral. They are written to protect capital, not communities. A global investor can move billions with a few clicks, but a small nation cannot stop those flows without punishment from markets or institutions. In such a system, stability for some means instability for others.
When the developing country faces a crisis, the solution often looks the same: borrow more, cut spending, and sell public assets. These policies may stabilize the books temporarily, but they rarely create long-term growth. Instead, they can hollow out a nation's economic base. Think of a government that sells its national power company or its mining rights to raise quick cash. The immediate debt problem might shrink, but the steady income from those industries is gone forever. The country loses both control and revenue, leaving it even more dependent on foreign investors the next time trouble strikes. This cycle isn't accidental. It's part of a structure that rewards capital over labor and creditors over debtors. Wealthy nations lend and poorer ones borrow. The interest payments flow one way. For decades, developing nations have paid back far more than they ever received in loans, yet their total debt keeps growing. The debt trap persists because each crisis demands a new loan to cover the old one. The deeper the dependency, the stronger the grip of those who set the terms. Foreign investment, which is often portrayed as the ultimate solution, brings its own paradoxes. It can create jobs and introduce technology, but the profits usually leave the country. Tax holidays, repatriated earnings, and transfer pricing allow multinational companies to extract wealth without leaving much behind. Local businesses struggle to compete with their scale and access to cheap financing. What remains is a shell economy, busy on the surface, but hollow within. Let's turn to the issue of trade. Trade is supposed to benefit everyone, yet the way global trade works often locks poor nations into disadvantageous roles. A country that exports coffee beans might earn a few dollars per kilogram, but the companies that roast, package, and sell that coffee make exponentially more. The reason is simple. Value is created not by raw materials, but by what's done with them. The poorer a country, the more it exports what it doesn't process. The richer a country, the more it imports cheap raw materials and exports expensive finished goods. Over time, that difference accumulates like compound interest, except it compounds inequality instead of wealth. Meanwhile, global corporations and banks shape the direction of world trade through lobbying and regulation. Agricultural subsidies in the United States and Europe, for example, allow their farmers to sell goods abroad at prices lower than the cost of production in developing countries. That undercuts local farmers who cannot compete with such artificially cheap imports. The result? Local industries collapse, rural communities suffer, and nations that were once food self-sufficient become dependent on imports.
Now, let's examine the role of global politics. Economic alliances are rarely about charity. They're about influence. When a rich nation offers aid, it often expects loyalty in return. Voting alignment in international forums, military cooperation, or access to natural resources. Development projects come with contractors from donor countries, ensuring that much of the aid money flows back home. So, even when assistance looks generous, it can reinforce dependency rather than reduce it. A subtler but equally powerful mechanism is control through finance. Global banks decide which projects get funded, which currencies are supported, and which economies are considered safe. When a poor nation proposes an industrial plan that doesn't align with global financial interests, it may struggle to attract investment. Economic policy thus becomes constrained not by what's best for citizens, but by what will reassure investors. There is also the psychological effect of inequality. Nations at the lower end of the global hierarchy are often told to imitate the models of those at the top. Liberalize trade, privatize state enterprises, cut public spending. But those prescriptions rarely acknowledge history or context. The nations that are now rich did not become wealthy by following these rules when they were developing. They used protectionism, subsidies, and state-led investment to nurture their industries, policies that are now discouraged for others. It's a form of do as we say, not as we did. The modern global economy runs on narratives as much as numbers. Investors believe in growth stories. Policymakers believe in markets. Citizens believe in opportunity. But when those beliefs collide with reality, when decades of effort produce little change, disillusionment spreads. The result is political instability, social unrest, and sometimes the rise of populist movements that promise to break free from global control. Breaking free, however, is not easy. Countries that try to chart independent economic paths often face sanctions, trade restrictions, or capital flight. Markets punish defiance swiftly. The message is clear. Prosperity is allowed, but only within approved limits. Still, history shows that change is possible. East Asian nations like South Korea and Taiwan managed to climb the ladder from poverty to prosperity within a few decades. How? By focusing relentlessly on industrial policy, education, and export diversification. They protected key industries until they could compete globally. They invested heavily in human capital and technology. Crucially, they negotiated foreign relationships on their own terms. Their success shows that while the system is stacked, it's not impenetrable. For many nations today, digital technology offers a new opportunity. The internet reduces barriers to entry in fields like software, design, and online services. A programmer in Lagos or Manila can compete globally without massive infrastructure. Yet even here, challenges remain. Unequal access to connectivity, reliance on foreign platforms, and payment systems controlled by global intermediaries. The digital economy can empower, but it can also replicate old inequalities in new forms. Environmental issues add another layer. Developing countries are often asked to limit emissions for the sake of global climate goals, even though their per capita emissions are tiny compared to those of rich nations. Meanwhile, they face the brunt of climate disasters, floods, droughts, and heat waves that destroy crops and infrastructure. Rebuilding after each disaster requires loans, which deepens the debt trap further. Climate finance promises have been made but often arrive slowly or in the form of loans rather than grants.
Let's not forget corruption, which many cite as the main reason poor countries stay poor. Corruption certainly matters, but it's often a symptom, not the root cause. When systems are designed to extract value outward, local elites learn to participate rather than resist. They benefit personally, while the nation loses collectively. Real anti-corruption reform requires not just punishing individuals, but changing incentives, ensuring that wealth generated locally stays local. Ultimately, the persistence of poverty among nations is not a mystery. It's the predictable outcome of a global system built on unequal exchange. The rules of money, credit, and trade were written in an era when power was concentrated in the hands of a few, and those rules have never truly been rewritten. They evolve cosmetically, but the logic remains. Value flows upward. For poor countries to escape this cycle, they must gradually regain control over their economic destinies. That means developing local industries, diversifying exports, investing in human capital, and strengthening regional cooperation. It means questioning the one-size-fits-all economic advice that has failed for decades. And it means demanding a fairer seat at the global table, one that reflects not just the size of economies, but the aspirations of billions of people. The story of global poverty is not a tale of incompetence or laziness. It's a story of systems that can be changed, but only through awareness, courage, and cooperation. Understanding how money truly moves is the first step. Because once we see the hidden mechanics of global finance, we realize that poverty is not inevitable. It is maintained, sometimes by design, but always by neglect. To anyone watching or listening who cares about a fairer world, the challenge is not just to feel sympathy, but to understand structure. Only through understanding can reform begin. And every reform starts with the same question: why must the world stay this way? Foreign aid was never meant to keep countries dependent. At least that was the official story. But over the decades, it has often created a cycle that quietly benefits donor nations more than the recipients. When rich countries lend money to poor ones, the loans usually come with strings attached, conditionalities, as the IMF calls them. Governments must privatize industries, cut subsidies, or open up to foreign investors before they can receive the next tranche of aid. On paper, these policies promote efficiency. In practice, they can dismantle local industries and expose weak economies to predatory global forces long before they are ready to compete. The same logic applies to debt. Many developing countries spend more on interest payments than on education or healthcare. Imagine trying to build a future while most of your national income flows back to creditors in New York, London, or Paris.
The debt itself becomes a tool of control. It ensures that the global financial system continues to favor those who already have power. To understand how deep this trap runs, let's rewind again, this time to the 1980s. The world was emerging from an oil crisis, and global interest rates were rising sharply. For dozens of developing nations that had borrowed heavily during the 1970s, the sudden increase in rates turned manageable debts into impossible burdens. The result was the so-called Third World Debt Crisis. Countries like Mexico, Brazil, and many across Africa were forced to seek help from the IMF. And that help came with strict conditions. Budgets were slashed, currencies devalued, public sectors downsized. Economies that had once been growing rapidly were thrown into recession. For ordinary citizens, it meant unemployment, higher prices, and lost hope. For the global lenders, it meant repayment, guaranteed by austerity. Even today, the legacy of those decades remains. The infrastructure projects that could have transformed local economies were postponed. The education budgets that could have built skilled workforces were cut. A generation was lost to policies designed to stabilize balance sheets rather than build prosperity. But economics isn't just about policy, it's about power, and power always finds a way to preserve itself. Look closely at the map of global trade, and you'll notice something striking. Most raw materials still flow from the poorest regions to the richest. Whether it's oil, gold, coffee, or cobalt, the story repeats itself. Poor countries export cheap, unprocessed commodities. Rich countries import them, refine them, and sell the finished products at a much higher price. The difference, the profit, stays in the developed world. This is what economists call the value chain gap. Take cocoa, for instance. West Africa produces over 70% of the world's cocoa beans, yet it captures less than 5% of the global chocolate market's value. The reason is simple. Manufacturing, branding, and distribution, the high-profit stages, all happen elsewhere. The same holds true for lithium in South America, cobalt in Congo, and crude oil in Nigeria. The raw material leaves, but the wealth it creates rarely returns. Now, you might ask, why don't these countries just move up the value chain? Build factories, refine their own materials, create brands of their own? The answer, again, lies in global structure. Multinational corporations dominate supply chains. They set prices, control logistics, and often lobby for trade rules that keep competition low. For a small developing nation to challenge that structure requires massive investment, stable governance, and access to markets that are often tightly guarded. And then there's the issue of brain drain, one of the most overlooked yet damaging aspects of global inequality. Every year, thousands of talented engineers, doctors, and scientists leave developing countries in search of better opportunities abroad. Their education is often subsidized by their home countries, yet the benefits of their skills are reaped elsewhere. Over time, this drains not just labor, but also hope, the very human capital needed to drive development. Still, poverty isn't destiny. History shows that countries can break free. South Korea, Singapore, and Taiwan once faced the same challenges: limited resources, colonial legacies, and high inequality. What made them different was a combination of leadership, strategic investment in education, and strong institutions capable of protecting domestic industries until they were ready to compete globally. They didn't follow the same formula prescribed by the global financial system, at least not blindly. They built their own path, often resisting the push for premature liberalization. The lesson is simple but profound.
Economic freedom without economic strength can leave a nation weaker, not stronger. As the 21st century unfolds, new players have entered the game. China, India, and a rising group of developing nations are beginning to rewrite the old rules. Through infrastructure investments, technology, and South-South cooperation, they're creating alternatives to the traditional Western-dominated model. Whether these efforts will truly bring balance or simply shift power from one hand to another remains to be seen. But the conversation has begun about fairness, sovereignty, and the right to shape one's own economic destiny. That conversation is long overdue.
Today, poverty no longer looks the way it once did. It's not always visible in dusty roads or empty fields. Sometimes it hides behind skyscrapers and smartphones, because in a globalized world, appearances can deceive. A nation may have glittering cities and record GDP growth, yet most of its citizens still struggle to afford food, housing, and health care. The question then isn't just why poor countries stay poor, it's why inequality continues to deepen, even in places that appear to be developing. The modern global economy is built on networks of finance, data, and trade that are more complex than ever before. Money moves faster than governments can regulate it. Corporations are larger than entire nations, and as wealth becomes digital, it concentrates in fewer hands. The same technology that connects us also creates divides. High-frequency trading, global tax havens, offshore investments, these are the new frontiers of inequality. Consider this. Every year, developing countries lose hundreds of billions of dollars through illicit financial flows. Profits that should be taxed locally, but are instead shifted offshore to secret accounts. These funds could build schools, hospitals, and infrastructure. Instead, they sit in foreign banks, compounding interest for a few, while eroding opportunity for millions. The result is a paradox. Developing nations often have abundant natural resources and young, dynamic populations, the very ingredients that should drive growth. Yet they remain trapped by external dependencies, reliance on imported technology, foreign capital, and volatile commodity prices. It's a cycle that repeats itself, a global pattern where wealth extraction is disguised as progress. Even international trade agreements, often celebrated as tools of development, can lock inequality in place. When developing countries open their markets, they face competition from established industries in the West or East that already benefit from decades of technological advantage and state support. Meanwhile, tariffs and quotas often remain on the very products that poorer nations could use to climb the value ladder. It's a subtle form of economic gatekeeping. Education was once seen as the great equalizer, and in many ways it still is. But education alone cannot fix a system that rewards capital more than labor. If innovation and entrepreneurship are to thrive in developing countries, they must be matched by access to credit, infrastructure, and fair markets. Otherwise, talent becomes another export commodity, young minds leaving home in search of opportunities elsewhere. Still, change is possible, and it begins with understanding. Understanding that poverty is not simply the result of laziness or corruption, as some narratives claim. It is the outcome of structures built over centuries, colonial, financial, and geopolitical, designed to favor some and disadvantage others. Breaking those structures requires both internal reform and global cooperation. Internally, developing countries must strengthen institutions, courts, schools, tax systems, and public accountability. Without them, corruption thrives and wealth flows upward instead of outward. Externally, there must be a shift in how global finance operates, more transparency, fairer trade, and a genuine effort to support self-sustaining growth rather than dependency. Technology offers both a challenge and an opportunity. Digital currencies, mobile banking, and decentralized finance could help citizens bypass broken systems and connect directly to global markets. But without regulation and inclusion, they could also create new forms of exploitation. The next economic revolution must learn from the mistakes of the last. Progress must not come at the expense of equality. And then there's the role of everyday consumers, people like us. Each purchase we make, each product we choose, each company we support, all ripple through the global economy. The world's wealth imbalance isn't maintained by governments alone. It's reinforced by patterns of consumption. Awareness is power, and collective choices can shift incentives faster than policy sometimes can. Because in the end, money isn't just currency, it's influence. It shapes who gets to make decisions, who gets to innovate, who gets to dream. When that influence remains concentrated in one corner of the world, development everywhere else slows down. Imagine for a moment a truly balanced world, where a farmer in Ghana earns a fair price for his cocoa, where a young coder in Lagos can build the next global tech company without leaving home, where resources extracted from the earth benefit the people who live above it, not those thousands of miles away. That world is not impossible. It just requires courage to question the systems we've accepted for too long. History shows that change rarely begins from the top. It starts when people understand how the system works and demand something better. The first step towards solving inequality is education, and the fact that you're watching this means you're already part of that movement, the movement to understand how money really moves the world. So the next time you hear about economic growth or foreign investment, ask who truly benefits. Growth means nothing if it doesn't lift lives. Investment means little if it doesn't empower people. True development isn't measured by numbers. It's measured by dignity, opportunity, and freedom. And that's the real challenge and the real hope for the century ahead. If this video opened your eyes or gave you a new way to see the world, take a moment to like the video. It really helps more people discover these ideas. And if you enjoy learning about how money, power, and policy shape our lives, make sure you subscribe to ExplainWise 91 and turn on notifications. That way, you'll never miss the next deep explanation that helps you understand how the world truly moves. Remember, awareness is the first step towards change. Thank you for watching, for supporting this channel, and for being part of a community that chooses to stay informed. Stay curious, and see you in the next one.